please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
That big exclusive interview with the Chief Economic Advisor, Arvind Subramanian. So I'm going to toss it over to Latha Venkatesh.
The GST Council meeting in Guwahati was nothing short of a mini union budget. It brought down on more than 215 items, and some of them by over 10 percentage points. That, while it did excite a large part of the Indian economy, has left a large part of the bond market a bit worried whether the government will be able to make up enough by way of revenues and whether there will be extra borrowing by the government in the months of Jan and Feb. Since then, we have seen the bond yields, the 10-year bond yield, go past the 7% mark. Of course, it was abetted ably by the higher crude prices as well. So, how are the government finances? How do the cut in the GST rates tie in with growth momentum in the economy? For all these questions, I have with me absolutely the man of the moment, the man who has contributed seminally to the revenue calculations in the GST, Mr. Arvind Subramanian, the Chief Economic Advisor. Good morning, Mr. Subramanian, and thank you very much for joining us today. There are plenty of questions that the market would like clarified from you. And the first of these is exactly the fiscal deficit and how does it fare after this giant cut in over 200 items of GST rates?
I think that it's fair to say that, underlying fiscal numbers we'll have to look at as the year progresses. Mm-hmm. But the marginal impact of the cuts in Guwahati, those are going to be, manageable, and they themselves are not going to have any serious impact on the overall fiscal deficit because, there's been a cut which, of course, in the first instance will lead to some reduction in revenue. But I think it can be offset partially or wholly by compliance benefits and also by, progressively as the base expands. I think so. So the impact of that is, on the one. Second, of course, is that the flip side, whatever the revenue impact is going to be, the flip side is that there's also going to be, some reduction in the price level as a result of those cuts. So it kind of works both ways. So to some extent, I think to the extent that bond markets look at that as well, I think that also has to be factored in as a positive development, which will keep a lid on inflation this year going forward.
No, I take your points, compliance benefits as well as price impact. I'll come to that in just a bit, but we got that number from the GST Council that 20,000 crores is the impact of the tax cuts. That is an annualized number, right? That's not a 4-month number or a 5-month number.
No, that's an annualized number. Yeah, that's an annualized number. Okay. But also that's a number that is what we would call in economics ceteris paribus, which is that all else being equal, i.e. that doesn't factor in compliance benefits, expansion of the base, any implied impact on the price level and so on. So it's a kind of limited calculation.
Okay, well, fair enough. But if you can just tell me, therefore, that would the GST Council therefore look at cutting the rates for the other, just 22% of the items in the 28% bracket? If the impact is so minimal, and if it will come with attendant benefits, would cement, paints, and other uses of mass consumption also be considered?
See, the thing is that recall that the way the GST Council has gone about this, I mean, I would call this a strategy of, pragmatic, incrementalism, which is that, you have to balance competing concerns. On the one hand, I think everyone has recognized, the GST Council and everyone, that the 28% slab was very high. It also led to complications and high prices. And so there's been a very consistent movement towards paring down items in that slab. And that's what you've seen. But of course, at every point in time, you have to also balance, I mean, exactly the point that you raised earlier, that, there are going to be revenue losses from that. So how do you balance that? And that's the way we've gone, the GST Council has gone about it. I think items like cement and stuff are big revenue earning items. And I think the GST Council will take a view over the next few months, how are revenues faring? And then the more there's comfort and reassurance that, we can kind of, in a sense, fiscally afford it, I think more those decisions will be taken. Because I think the direction is absolutely clear that the 28% slab, I mean, eventually you want it to be nothing more than what we call demerit goods, even in the report that I co-authored. So that's, I mean, the destination. And I think we're progressing towards that much quicker than many had anticipated.
No, actually, that report of yours, which is, I think, the intellectual foundation of all these rates, was also arguing for fewer slabs. You see that principle being adopted in the months to come?
Yeah. Absolutely. I think that, these are all decisions, further paring down the 28, reducing the number of slabs. I mean, these are all going to be on the agenda going forward. I think because I think everyone has recognized, I would say, for example, that in a country like India, tax policy is maybe, I don't want to exaggerate, but tax policy is a lot of tax administration, because the simpler the structure, the easier the administration, right? And so the need for simplicity and lack of complexity is well recognized. I think on the 28 we're moving, and I think that at some stage we can cut down maybe one more slab. I think then we would be approaching even the structure that I had recommended in that report. So we're headed in that direction, because the principle that there should be few slabs, simplicity, is now absolutely completely embraced, I think.
Absolutely. Take your points, and I guess some of the fears also have now realized or are now found to be unfounded, if you please. For instance, the banking sector, the insurance sector, the telecom sector was seriously worried about 30 registrations. It has not been all that complicated at all for them. Therefore, in that spirit, do you think the GST Council is also on the verge of accepting real estate or petro goods sometime soon within the GST ambit?
So before we get to that, I also want to emphasize that, in the spirit of simplicity and reducing complexity, I think the other major decision that was taken at Guwahati, which perhaps has not received the attention that it deserved, was the fact that, the compliance burden, specifically, GSTR 2 and 3, that compliance burden has been significantly reduced, so that for some time at least, those two forms which were creating a lot of problem, those have also been temporarily put aside. So I think that's another big improvement in compliance burden that's happened, apart from the fact for the composition scheme, the threshold could go up from 1 to 1.5 crores. That also, I think, so the notion of simplicity extends not just to the tax structure, but also to the compliance burden. Okay. Now coming to your question, I think that land and real estate was on the agenda at the last meeting, but we just could not get to it because of lack of time. It's going to come back on the agenda probably even at the next meeting. And so, I think that the parallel exercise of how do we expand the base, land and real estate, electricity, and then, of course, petroleum and natural gas products, I think those are all going to be on the agenda going forward. I think land and real estate is the first up, and there too there's, kind of a lot of positive momentum building that this would be a natural complement to the other actions that the government has taken, because a lot of black money is tied up in land and real estate. And if we could clean it up, bring in more transparency, I think that would be a big step forward. So I think there too, the general sense is that we're moving in the right direction, and that there's a shared understanding, not universal maybe as yet, but a wideningly broad, a shared understanding that we need to expand the base, and that land and real estate need to be brought in sooner rather than later.
Okay. Oh, well, this is perhaps one of the most healthiest developments. Would you expect that within this fiscal? Since you say it is in the agenda of the next meeting, including land into GST?
It was, I think, again, putting a timing is always very difficult, because remember, it has to be decided by the GST Council, where there are lots of competing, sometimes, divergent interests. Forging a consensus is not easy always. But, just as we saw with the 28%, we saw with the simplification, there is momentum building in that direction on land and real estate. So, it's very difficult to say March, April, May, but I think we are moving in that direction. I think that's all one can say at the moment. Yeah, it's a very positive development.
Fair point, sir. I did not forget the procedural, SOPs that were given, or the procedural improvements that were announced in Guwahati. I'm coming to that in just a minute. But before that, you refer to the CPI as one of the advantages which the bond market ought to take cognizance of. What is your own calculation? How much might it bring down? How much might it impact the CPI? 30 bips, 40 bips, 50 bips?
I haven't done the exact calculation, but I've seen estimates between 20 and 40 basis points for that, and it sounds plausible. By the way, I just want to come back to, I think the other sector which I think is very important to bring into the ambit of the GST is electricity, because I do think that the electricity taxes get embedded in the supply chain and kind of undermine the competitiveness of Indian manufacturing. So I think from a competitiveness standpoint, giving Make in India a boost, I think bringing in electricity would also be something that would be highly desirable. So land and real estate has the virtue that it's part of the cleaning up, transparency, corruption agenda. I think electricity would be part of the how do we make Indian industry more competitive, part of that agenda.
And there is a buy-in for that from the council?
I think, again, we will move slowly in that direction as well over the next few months.
Fair enough. So let me just complete the other fiscal deficit worries that pushed the bond yields up. There are a couple of things that the market was obviously worried about. Crude going to, $65, though it is off that level now. As well, the way in which the market borrowing program has been arranged. After mid-January, there is only 5,000 crore that's been apportioned for the next 5 weeks, giving the feeling that more borrowing will be put in those weeks. What is your sense? Will the government need to borrow more?
See, I think let's first understand why I think bond yields have been tightening, right? Have been rising. I think at least 2 or 3 factors have come into play. I think, first of all, oil prices have gone up. I think that's one important fact that you mentioned. I think also that, for example, U.S. treasuries have also gone up by 20-25 basis points, and the sense that now if you do get a tax cut in the United States, I think that would also lead to higher interest rates and therefore So there are external factors at play. I think there's also, to be fair, that the sense in the markets, perhaps rightly or wrongly, that the direction of monetary policy is now going to be in one direction, yes, and not kind of evenly balanced. Maybe there's that perception as well. So all of those are factors affecting bond yields.
Absolutely.
And then, of course, over and above that will be the fiscal situation, right?
Yes.
Now, I think on the fiscal situation, as I said, it's a bit early to get a sense of where, because remember, it's not just what's going to happen on revenues and expenditures. It's also going to depend upon the recapitalization and how we structure that, how government structures that recapitalization as well. There are lots of issues there. How should these be recapitalized in a way that doesn't crowd out other borrowing? So these are all decisions that will be made over the next few months. And I think it's a bit too early to say, will borrowing go up or come down? Let's take stock once all the data come in and once big decisions have been made on recapitalization and so on.
Okay. Well, actually, recapitalization was in my second half list of questions, but since you allude to it, can you give us some update on how it is designed? It is going to be via a recapitalization bond, is that right? And will there be a special SUTI kind of undertaking set up which will issue any updates at all, sir, on the structuring of the bond? SLR, non-SLR, HTM, non-HTM?
No, see, I think that, these are all, nothing has been decided as yet. I think the government is having intense discussions on this, consulting widely. And I think, these are decisions that will be made over the course of the next weeks and month perhaps. But all these are, government is aware of all the factors that, go into decisions on how to structure these recapitalization bonds. And I think that, at the end of the day, I think some very measured, calculated decisions will be taken. And one important consideration will be how not to unsettle bond markets as well. So the principle and the objective is well recognized. I think the details will have to be worked out, are being worked out over the course of the next few weeks and months.
Well, even as you say that, bond yields have now dipped to 7.02.
Also, we have to wait. Yeah.
Yeah, please, go ahead, sir.
That's good. No. I was also saying, we, the financials have to come in for the state banks and so on. So let's see. A lot of more data is also required. In terms of how exactly to structure the recapitalization. Okay. How should be allocated across the banks. And the issues that you raised, SLRable, whatever, tradable, etc., etc. All the stuff that have been talked about in financial markets. I think government is acutely sensitive to those factors, and they'll be incorporated in a very kind of measured manner as government takes these decisions.
Okay. Well, in that case, Dr. Subramanian, can the market at least assume that it is going to be a recap bond? Because repeatedly news reports surface that the Reserve Bank will be asked to help in capitalizing some of the banks. Is that also a conversation that's happening, asking Reserve Bank to give an interim dividend?
I think it's not, a government is having serious internal discussions. I mean, these are all things that, may or may not come into play. But, the government has certainly made its own plans, based on its own assessment of how much money to put in and how to put that in. And so at this stage, I think these discussions are underway and, and all these things will be taken into account.
Okay. Well, just to finally end the fiscal deficit discussion part, there are some who believe that even now the GST collections are a little more than what they were expecting. So what's your final assessment of fiscal deficit? We were starting with a bit of a disadvantage in terms of the RBI dividend being lower, in terms of spectrum revenues being lower, and in terms of some of the cesses being given up by the government, though, of course, it may come back in the form of GST. So are we even on fiscal deficit, or is there a very good chance that it is a little more than 3.2%?
I think the point that you raised on the GST, I think it's important to underline that, we've only had, 3 months of data so far, right? And it's not enough at this stage to come to a definitive assessment of how, GST is faring. For example, the IGST collections, not all of that has been settled.
Yes.
So we won't know how they will be settled until the whole refund mechanism, the transitional credits all play out. So it is, too early to get a considered definitive assessment of how GST is performing. So we need at least another 2 to 3 months of data before we make a considered assessment. And the same thing holds for the other items of revenue, both tax revenue and non-tax revenue as well. These are early days. There's a lot of seasonality, and there's also in terms of the non-tax revenue, these things become clearer as you approach the end of the fiscal year. So let's wait and see before we come to an assessment. I think it's too early to say, but let's see. And then there's the whole recapitalization agenda as well. So it has to be a kind of a considered assessment, taking all the new factors that have come into play as well.
So you won't put an upward risk to the fiscal deficit number of 3.2?
At this stage, it's premature to, do upward or downward at this stage.
Okay, fair enough. Now let me come to that procedural part that you were saying. One will expect that, of course, to play out in the months to come. But for the moment, the export numbers, we were running at a $22-23 billion export number for a better part of 2017. We didn't seem to be participating in the global recovery, probably because of the demon and then the GST disruption. September was a pleasant surprise, but again we are down in October. So is there some niggling GST worry that's keeping our exports down? What's keeping exports down?
See, first of all, I think if you look at the non-oil export growth, if you kind of do the seasonal adjustment and all of that, I think for the last few months, we've been running at about I think my estimate is about 9% non-oil export growth, seasonally adjusted 3-month, not, moving average kind of thing, which is substantially greater than what we were doing, 8-9 months ago. So the trend in terms of non-oil export growth has, picked up relative to, where we were for much of 2016, for example.
But that average could have been...
What remains to be seen is
that average, sir, is that average after yesterday's numbers?
No,
because garments have fallen by 40% almost. And gems and jewelry are up to 29%. So, looking worrisome?
No, I mean, I did do the numbers after yesterday's numbers. So these are, moving averages. If we do the moving averages, it's about, we're running at about a little over 9% on non-oil exports, which is much higher than the 1 and 2 and 3% we were doing for much of 2016. So there has been a shift up. But as I said, the question is, are we picking up commensurate with what we know other Asian economies are picking up? they're doing gangbuster export growth.
Yeah.
Bangladesh, Vietnam, South Korea are also doing much. So the question is whether we're doing as well as they are or not. And, we need to look at that a little bit more carefully. Also, I think we need to see, what kind of, when we stabilize after, the early stages of the GST implementation. And so I think towards the end of the year, early next year, we'll get a better sense of, having put the teething, whatever transitional challenges behind that, are we at a significantly higher pace of export growth or not? And also then, we will get the data on GDP at the end of the month. We did see that, the IIP for the second quarter was not spectacular, but it was better than the first quarter. So, where we're going to stabilize, is the momentum, back in the right direction. We'll also get to know when the November, when the GDP data for the second quarter come out.
Okay. Fair enough. But as you say, we are underperforming the region and several of our peers in terms of export growth. Would you visit that on the GST transition? Therefore, any SOPs on the way for exporters in terms of, not having to pay the taxes and then claim it back? Any procedural ease on the cards?
Well, remember that on the export, we changed, in fact, not this, but more than a month ago.
Yes, you did.
Exporters, we gave them relief by saying that they would not have to pay the IGST on taxes or on imports. I think there was that procedural benefit that was given. We also allowed them to use the old drawback until the end of September. And so I think the government is very acutely aware of the problems of the exporters, I think. So I think that and we're going to be monitoring constantly because of that. But remember that in order not to burden and blame the GST, our export performance also is affected by a lot of other factors. I think that the general state of the economy, the twin balance sheet problem, the level of interest rates and exchange rates, all of these play into export performance. I think that one shouldn't just attribute all these just to the GST, although the GST, the transition, may have some impact as well.
No, usually the health of the destination countries, overpowers all this, but at this point in time, it is not. But that's a separate discussion. Let me just speak about this, export weakness and. No.
I think.
Yes, sir. Sorry, you were saying?
No, I was saying that you were right, but at this stage, you're right about, the state of demand in international markets, but that has been turning favorably for all exporters. So, your point is a very valid one. Yes.
Okay. Well, sir, I just want to end this conversation by asking you about the general state of growth itself. The argument has been made even by the Reserve Bank and by people in government that the Indian economy had slowed even before demonetization and GST. Now, is that niggling slowdown still a worry? Look at the October numbers, look at the PMI, look at the auto sales numbers, and exports now. Is there a niggling worry that that slowdown is still there? And therefore, the number we will get for November 30th, as well as the overall GDP number for the year, could be a disappointment?
I think that I am, completely waiting for the November numbers because, you're getting indicators in all direction. I mean, you're getting, because certainly the IIP improved in the second quarter relative to the first quarter.
Yes.
I think export growth, notwithstanding yesterday, has been, as I said, if you do the, on a, more long-term basis, growth has been higher than in the past. But there are also, other factors weighing on the economy. So I, at this stage, will reserve judgment until the November numbers come out and see whether both the level and directionally where we're headed. I think I want to wait for that.
What is your working number, though, on GDP, sir, for the current year? And for the November quarter, if you have.
You know, we had... No, I don't, you know, we had a number in the survey, you know, in July, August, when we brought out the survey, we made clear what our thing was. We said that we expected it to not to be in the higher end of the range that we had originally forecast, maybe more towards the middle or the lower end of that range, which is, you know, close in line with what the, you know, the consensus is for the year as a whole. So let's just wait and see whether, you know, the November numbers are in line with those forecasts or not.
All right, Dr. Subramanian, we'll leave it at that. Thank you very much for this very useful chat. The bond markets definitely are feeling reassured, at least going by way the bond yields have moved. That on fiscal deficit, the chief economic advisor is still neutral, no upward bias and no downward bias. As well, convinced that the GST Council is going to take up the real estate and land issue as well in forthcoming meetings. The general direction is very good, and perhaps with some luck, we could see our exports as well firing. He's not terribly disappointed by the second quarter export growth performance. Thank you very much for joining us on this special chat that we have had with the Chief Economic Advisor.